Welcome to The Explainer. Today, we are digging into something pretty serious. Why, according to the source material we've looked at, the U.S. economy might not be able to handle even a simple run-of-the-mill recession. The math suggests it could actually trigger a catastrophe.
Okay, so let's get right into it. Why would a normal recession be so disastrous? Well, the problem is that the usual economic playbook we use to fight a downturn, it might not work this time. In fact, the very tools we normally rely on could end up making things a whole lot worse. To really get why, we have to look at our starting position.
And that starting point is, well, historically fragile. Before a recession has even started, the U.S. government's finances are already on pretty shaky ground in a way we just haven't seen during normal, good economic times.
See, we're running what economists call a pro-cyclical deficit. Now, normally, when the economy's doing well and jobs are plentiful, governments are supposed to tighten their belts and shrink the deficit. Save up for a rainy day. We are doing the exact opposite.
And I want you to really focus on the scale of this. Right now, during quote-unquote good times, we're running a deficit of 7% of GDP. To give you some perspective, those are numbers we've only ever hit during massive global meltdowns like the 2008 financial crisis and the 2020 pandemic. We are starting this race already in a very, very deep hole.
And this chart right here, this really gets to the heart of the problem. Over the last 70 years, government spending as a piece of the economic pie has doubled. But at the same time, federal revenue, the money the government actually brings in, has stayed completely flat. That huge growing gap, that's the source of all this.
Okay, so that's the setup. Let's look at the first domino. What happens to this already strained budget when just an average, everyday recession finally hits? You get slammed by this painful pincer movement. The government's income goes down at the exact moment its expenses are forced to go way, way up. And we're not talking about a small change here. The numbers are just staggering.
First up, let's talk revenue. If you look at the average of the last three recessions, that's 2001, 2008, and 2020, federal tax revenue typically drops by about 15%. It makes sense, right? People lose jobs, company profits fall, and so tax payments just plummet.
So in today's numbers, a 15% drop means government income falls from almost $5 trillion a year down to just over $4 trillion. That's a massive $730 billion hole blown in the budget from the income side alone.
But of course, it gets worse. At the very same time, government spending on things like unemployment checks and stimulus programs jumps by an average of 29%.
A jump like that would push our annual spending from under $7 trillion all the way up to nearly $9 trillion. So think about that. The government is spending way more to fight the recession while its income is collapsing. And here's the bottom line. You combine that falling revenue with that skyrocketing spending, and your annual deficit just explodes. It more than doubles from its already huge level of around $2 trillion to a mind-boggling $4.5 trillion.
A deficit that big is bad enough, you'd think. But as our source material warns again and again, that is not the end of the story. The math is about to get a whole lot uglier because of how this deficit interacts with the rest of the economy.
Okay, so now we have to talk about the economic balance sheet that's supposed to handle all this new debt. Because it's not just the deficit number that matters, it's the size of that deficit compared to the entire economy. The key metric here is something called the deficit to GDP ratio. The easiest way to think about it is like a country's personal debt to income ratio. It tells you if your debt is manageable or if it's just completely overwhelming your ability to pay for it. And this ratio has a really nasty habit during a recession.
And here's that nasty habit, the amplifier effect. It's not just that the deficit, the top number of the fraction, skyrockets. At the same time, the GDP, the bottom number, the whole economy that has to support this debt, actually shrinks. So when your numerator goes way up and your denominator goes down, the problem gets exponentially worse.
The result? A deficit to GDP ratio of 15.5%. That is a level that would be absolutely unprecedented in modern American history, outside of something extreme like a complete global economic shutdown. So all of this brings us to the final act, and frankly, the most dangerous part of this story. What happens in the bond market?
This is where the government goes to borrow all this money, and it's where the old rules seem to be completely breaking down.
For decades, the recession playbook was super simple. A recession hits, the Fed cuts interest rates, and that makes it cheaper for the government to borrow money. Simple. They called it a bull steepener. But lately, we've started seeing the exact opposite, a bear steepener, where the Fed cuts its short-term rates, but the long-term borrowing costs for the government actually go up.
So you have to ask, why is this happening? Well, the data suggests the market is just full. It's saturated. The amount of debt compared to the economy has doubled since 2007, and the Federal Reserve has had to step in and buy more and more of it, tripling its own holdings, basically because the private market just doesn't have the appetite for this much debt at super low interest rates anymore.
This kicks off what analysts call a debt doom loop, and it's as terrifying as it sounds. A massive deficit means you have to issue trillions in new debt. The market can't absorb it, so it demands higher interest rates to buy it. Those higher rates make the government's interest payments explode, which of course makes the deficit even bigger, and then you go right back to step one. It's a vicious cycle.
In a world like that, your $4.5 trillion deficit from the recession very quickly becomes a $5 trillion deficit, just from rising interest costs. Suddenly, the interest payments on the debt become the fastest-growing part of the entire federal budget, and the whole situation just spirals out of control.
So, what this all really boils down to is that the traditional tools we have to fight a recession, cutting rates and spending money, could now be the very things that trigger a bond market crisis and make everything worse. The old economic playbook seems to be breaking, and that leaves us with a really unsettling question. If the tools we've always relied on suddenly start to work against us, what happens next?